Hey everyone, Daniel Snyder here from Seeking Alpha. Thank you so much for tuning in to this great webinar, 6 beaten down stocks rated buy right now. Now, we've done this webinar before and the picks turned out pretty great. So we're going to dive into some of the recap there and we're going to give you some new names today. And as Steve said right before we jumped on here, it was pretty easy to find these stocks this time. This market is interesting, is it not? But before we dive into the conversation, let's go ahead and get a quick legal disclaimer out of the way. We are not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment, security, or strategy, or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by future events. It represents my opinions or Stephen Cress's opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results. Seeking Alpha is not a licensed securities dealer, broker, or U.S. investment advisor or investment bank. Now, with that out of the way, let's dive into the conversation. I'm excited for this one, Steve. I don't know about yourself.
Daniel, thank you so much for organizing to this today. And you're right. Yeah, we did this, I think, back in August, and almost all, I think, five of the stocks were stellar performers. One of them didn't really perform that well, but five of them absolutely did. So we thought we would go with this concept again. Uh, Markets, to a certain extent, are getting soft here. So we were able to pick up some six stocks. And actually, as of today, there's many more stocks that have been beaten down. Remember when we did this back in August of last year? It was not as easy to find those beaten down
Yeah.
stocks, but we found them. They did well. You went back even a couple weeks ago when I started to look at the stocks that I wanted to select for today. It was not as easy to find the beaten down stocks, but certainly over the last week, things are starting to roll over, and we'll touch on that a little bit. So today we'll cover in the presentation why quant. For those who are not familiar with quant, we'll go over our process. We'll give a little bit of a review of the current market conditions, and then we'll get right into our six beaten down stocks. So what is quant? Well, I look at quant basically as fundamental analysis. We're really no different than those analysts that work at Merrill Lynch or Morgan Stanley or Goldman Sachs. However, we sort of take that same process and we introduce the power of computer processing. So it gives us the ability, instead of being one analyst that could cover maybe a dozen companies, to be one quant strategy team that can cover thousands and thousands of stocks and refresh it every day. So quant is a data-driven process. We use obviously a lot of data. We use math and we use algorithms to find investment opportunities and occasionally manage portfolios as well. One of the key things that we try to do with quant investing is actually eliminate emotions. Whether you're an institutional manager or an individual investor, sometimes you can really get quite attached to stock. You might be a really big believer in what management is doing, or perhaps the person that gave you the recommendation you think very highly of. And often that is a poor way to judge investing in a stock. So what we try to do from a quant basis is we look at core metrics such as value, growth, profitability, and we look at the underlying metrics for each of those styles, and we assess it by the strength of those metrics relative to the rest of the sector using that individual metric. So it's a systematic process. It's not me going in and really sort of hand picking stocks and doing my own research. It's a systematic process that sorts through thousands and thousands of stocks every day, going through the cash flow, balance sheet, income statements, and dozens and dozens of financial metrics, all to determine which company has the best metrics. And those that have the best collective metrics on growth, profitability, momentum, and EPS revisions will come out as the strongest companies, and those with the weakest scores will often come out as sells or strong sells. So as I mentioned, we have those core metrics that we look at that are particular to our quant model. I would add it's somewhat of a GARP approach. It's growth at a reasonable price. Many quant models will focus just on momentum or deep value or strong growth. We tend to look for companies that are collectively strong on a handful of metrics that I just mentioned. And again, we score all those metrics to identify the strong companies from the weak companies. And we have a pretty good track record. So as you can see here, what I've done here, and this isn't really an investment product that you could allocate capital to. It's more or less showing you our performance to provide sort of that real living life example that the strategy actually works. And what we do is we take every strong buy every single day going back to 2010, and we put it into a portfolio of a stock is not a strong buy, it comes out of the portfolio. So measuring every single strong buy we had going back to 2010, you can see it's had huge performance. So if you took $10,000 in 2010, that 10,000 would be worth $324,000 today, versus if you put $10,000 into the S&P 500, which would be worth roughly 62,000. And I will say, as you look at this graph here, you'll see the period from 2010 to 2019. That was actually our back test. After 2019, it was actually the trade. So our system was up and performing, and we basically measured every trade since 2019. So you could see it as it is. And the performance really started to skyrocket around 2020. So the strategy still works very well from a back test and from simulated trades. So getting a little bit more recent, going back to August 19th of 2024, as I mentioned, we came up with the concept of looking for stocks that had quant strong buys that were beaten down stocks. And you can see from August 19th to February 19th, the 6 beaten down stocks on average returned 39% versus the S&P for the same period, 9%. Now you're looking at some of the current ratings on the stock and the 6-month performance. So you can see some of them are still strong buys, such as Twilio, Carnival, and Trip.com. We have a buy rating on Corporation Americana. It's an airport service company in Latin America. And both Sterling and FSR fell to hold ratings. You can see to the right of the company's name the actual performance, and you can see that is monster performance versus the S&P 500 for 5 out of the 6 stocks. So I think it's a really good approach to sort of go with every once in a while. For the most part, we view momentum as a very important metric here. And you could even see on the stocks that we recommended back in August, if you look at the momentum grade, and remember that sector relative, many of them are still strong. Twilio has an A, Carnival has an A, Trip.com A minus, and Cap has a B. So that momentum grade is still strong. But in the near term, sometimes stocks sell off a little bit, and it often can present a really good buying opportunity. When we measure momentum, we actually look at 4 different time points. We look at 12 months, 9 months, 6 months, and 3 months. So it's actually 4 different time points that we're measuring for that momentum, and then we take the aggregate score of it. So whenever, like in a 1-month period or 2-month or 3-month period of a stock sells off, if it still has really great valuation framework, very strong growth, good profitability, it often could be a good stock to load up on if there's short-term weakness.
Steve, real quick to double down on that though, of what you just talked about is the stock sold off, right? Like
Yeah.
here's August 19th. If people remember, 2 weeks before this was the volatility event of August where the
Oh,
entire
yeah.
market freaked out and people were selling for no reason whatsoever. They were freaked out about stuff they didn't know. It was a blip in time. Markets, whatever reason they sold. But then the market came back. And then a month later, you have the Fed who actually stepped in and did the massive change and started cutting. And then we were like, okay, well, then what's happening in the market there? But I think what I also want to point out is they sell, but as you're mentioning, it's that 3-month and longer horizon that you're looking at that momentum. It's not daily, it's not weekly, it's not even 1 month. You're focusing on a longer time horizon with this strategy.
Well, Dave, first off, you got a great memory. I can't believe I actually forgot about that VIX surge that we had. And we did a webinar on it as well, not only for the 6 beaten down stocks, but basically just, telling investors to keep calm, manage on. There were a lot of talking heads out there that were like, sell everything. It's going to be a disaster. And if you remember, Daniel, it was really like, I believe it was a labor growth number that was lower than expected. It was still positive growth. It was just lower than expected, and the VIX went crazy. A lot of stocks sold off. So it was a great opportunity, just as you mentioned, to take advantage of it. And I think we're sort of in a situation now where, the S&P has been doing relatively well since the election. There is a lot of uncertainty out there right now, though. There's a lot of executive orders. There's a lot of directives, tariff news. So I think the markets, are a little uncertain, and it's creating some buying opportunities. And what we're doing is we're focused on companies that have really strong fundamentals, typically really good balance sheets, but great growth as well, good valuation frameworks. And that's why we're highlighting these opportunities. So sometimes you'll have one-off events, or in the current financial situation, there are a number of directives being issued that it could be more than like a short-term event, but these companies still have good fundamentals. So you want to take advantage of the companies that have good fundamentals when you have market sell-off similar to what we're seeing today, and what we might see in coming weeks as well. So, and that really brings me perfectly to this next slide. So we sort of mentioned um, what's going on. President Trump's return to the White House has created a lot of political uncertainty. Markets hate uncertainty, and I think we're starting to see evidence of that now. There's shifting policy decisions that will relate to market fluctuations. Um, that could mean and that could contribute to maybe a bit of a pullback. Historically, we've highlighted when you go into the third year of a bull market, you often can see a 10 to 20% correction, but during that same year, the market actually finishes up. So this wouldn't be out of the ordinary. And it seems like we have a couple catalysts here for the uncertainty. We also are beginning to find some persistent inflation. And on the back of that, obviously, there's interest rate concerns. If we went back to, say, August, September, October of last year, the markets were really looking for a number of cuts to happen in 2025. Now, interest rate traders are barely thinking there might be one cut. And that's because, inflation is continuing to rear its ugly head. We had the unveiling of DeepSeek's latest AI model, and that really threw off a lot of technology stocks. Um, Over the course of the last year, it appeared that there was going to be a really heavy demand on energy resources because data centers require so much energy. But when the news came out about DeepSeek not using nearly as much energy, it had it forced sort of a seismic sell-off in the U.S. tech sector. And then, of course, we have some earnings deterioration that could cause ripple effects going forward. We have some, the broader names right now that are reporting. It's not so bad, but we've had a couple big companies where earnings did come in a little bit worse than expected, and that is creating a ripple effect. And on top of that, if you look at the Mag 7 stocks, all of them have slower forward growth than their year-over-year growth. And I think as that sort of hits home with the market, that's having a negative impact too, or it's just creating uncertainty.
Yeah, the forward
So
guidance, Steve. I just want to mention we also talked about this.
good point.
Walmart this morning. This morning, Walmart, right? Beating, firing on all cylinders, but forward guidance giving the market a little bit of a spook. And that's kind of where you're seeing these fluctuations.
A day, I feel like that's sort of becoming a normalized event. We had our top 10 stocks in January, which skyrocketed. Most of the companies have been reporting better top line and bottom line than expected. But it seems like many CEOs, not only for those top 10, but for many companies in general, I think the CEOs are a little bit uncertain of what's going to happen. So they're offering guidance, that's a little bit tweaked, a little bit lower. But as soon as they tweak that guidance a little bit lower, the stocks are getting completely hammered, irregardless of their like record quarters that they're having or record years. So I think that's a really good point that you bring up. Obviously, I think something else that's interesting is we saw gold gain for 7 weeks in a row, and we haven't seen that since 2020. And that's kind of an indication of market uncertainty as well. It's the longest winning streak we've had for gold since the pandemic. So a couple other things that investors may be well aware of. We have 25% tariff imports for Canada and Mexico, except for Canadian energy, which will be a 10% tariff that was announced on February 4th. There's kind of been an extension to March. So they suspended the tariffs for Mexico and Canada, but it seems like they're still going to be there. There's a 10% tariff on all imports from China. Market losses were severe in early trading when that was announced on February 4th, particularly automakers, GM, Tesla, Ford, all have traded down since the announcement. And the CEO of Ford, I just remember him saying it's really chaos. They don't know what's going to be happening with steel prices. They don't know what's going to be happening with auto parts that are coming from Mexico. The CEO of GM saying, some parts could be 50% higher in terms of their cost. So just a lot of uncertainty on all fronts, whether you're a CEO or an individual investor. And many of these announcements have contributed, and this uncertainty have contributed to the long 7-week rally that we've seen with gold. I mentioned earlier that interest rate traders, initially when you went back to like August or September, October, they were looking for 3 or even 4 cuts for 2025. Right now, you barely see a notch for the upcoming Fed meeting. It looks like only 2.5% of traders expect a 25 basis point cut. So that is certainly not a lot. And the markets are currently pricing in that the Fed will maintain a hold policy in their upcoming meeting, which means higher for longer interest rates could lead to reduced consumer spending, which obviously could impact markets as well. Um, and as I mentioned early on in the presentation, this slide just sort of points to the Mag 7. As you can see in this chart, we have highlighted sort of in a light orange the year-over-year growth rates, and then the EPS forward growth rates in a darker orange color. And you could see with all the companies, with the exception of Tesla, that the forward growth is substantially lower than the year-over-year growth. So I think that's, really says volumes. So on average, the year-over-year growth was 77%, and the forward growth rate, the CAGR is 38%. So substantially lower going forward. And Mag 7, those stocks had a great rally in 2023 and 2024. Not sure we're going to be seeing the same thing going into 2025. And so far, that has not been the case. And these stocks are extremely expensive as well. They're really, when people say the S&P 500 is expensive, if you took out these 7 stocks and you were just looking at the S&P 493, that multiple would be significantly lower. All right, so that tells you a little bit about the uncertainty, a little bit about why we have some beaten up stocks, maybe a little bit of the reason why stocks might continue to be beaten up. And it means that you should be looking for opportunities where stocks have strong fundamentals, where they have quant strong buys, where they look at with the quant grades on growth, profitability, and value. So we're going to go into our presentation here. And I'm also going to sort of go back and forth at this point between the slideshow and the Seeking Alpha platform while we'll go to the stock page. So the first beaten down stock is Synchrony Financial, ticker symbol SYF, very large company with a market cap of 25 billion. It is in the financial sector and it ranks 16 out of 687. And within its segment of consumer finance, it actually ranks 5 out of 39. The stock is down 9.39% over the last 30 days. So not a big move down, but today it's had a down day as well. Some of the negative catalysts have been the macroeconomic headwinds, leading to more selective consumer spending and a tightening credit policies, which are leading to slower purchase volumes and loan growth for SYF in Q4. Positive catalysts, however, are improving credit trends, and delinquencies declined by about 4 basis points year over year. Management has also indicated potential for easing credit restrictions in the second half of 2025. So I'm going to take us to our platform now. And we're on Synchrony Financial.
While you're
Go ahead, Daniel.
While you're taking us to the platform, there was a question that came in that I think it needs to be clarified.
Sure.
When we say beaten down, how are we defining that in these stocks?
Yeah, I'm looking stocks that are down from their 52-week high. It could be a matter of a month or a 3-month period. So we're not looking for stocks that are down necessarily 20 or 30 or 40%. We're basically looking for stocks that have really strong fundamentals that have come off its high and are presenting an opportunity off that 52-week high.
And real quick to clarify, the 6 stocks that we showcased earlier in the deck, those were the picks from last August, and now we're diving into the 6 for right now.
Absolutely correct. So if you went back last August, I basically used the same rule. I was looking for stocks that were off their 52-week high over a 1 to 3 month period. And those stocks had a quant strong buy as well. So we use the same strategy today that we used back in August, and hopefully it'll pan out as well. So as you can see, we had an immense return for 5 of those stocks out of the 6. And my belief is, we should be seeing the same opportunity here today. So as we look at Synchrony Financial, which is down 2.65% in the last 5 days, it's down a little less than that. On the month, it's down about 8%. So I'm going to go to the right-hand side, and you'll see the rating summary. So our Seeking Alpha contributors, the consensus of our contributors is the stock is a buy. Wall Street consensus is a buy, and the quant has a strong buy. Those are 3 independent sources there. So the contributors are separate from Wall Street, and Wall Street is separate from our quant ratings. If you look below, you'll see those factor grades. And just as a reminder, those factor grades are in relative terms, not absolute terms. So it's relative to the sector. So the valuation grade of C shows that the valuation is fairly in line with the sector, but the growth of A minus shows that growth is superior to the sector. Profitability at A plus is completely superior to the sector, and it looks superior on both momentum and revisions. So again, it's the financial sector. So we'll take a deeper look. We're one click away from the underlying metrics that make up valuation. And that actually doesn't look so bad. I think the one element that brings that grade down overall is the dividend yield, the trailing dividend yield. Many financial companies have a dividend. The sector median is 2.91%, and Synchrony has a yield of 1.52%. So that's a little bit lower than the sector, hence the D. But on the other more conventional valuation frameworks, it actually looks excellent. The forward P is only 8.6 times versus the sector at 11.5 times. And if we were to look at it on a forward PEG basis, it's an A plus. And PEG is one of my favorite ratios because you combine growth together with the P evaluation. So you're actually using two different metrics to get the one blended one. And at 0.28, it's at a 78% discount to the sector median of 1.3%. If we were to look at growth, and we're one click away from that, you could see year-over-year revenue was very strong versus the sector. Part of the reason maybe why the stock is slowing down a little bit is the forward revenue growth is a little bit lower. However, the bottom line continues to remain very, very strong. So we look at EPS growth on a forward basis. It's a B plus. It's an 18% forward growth rate versus the sector at 10.79. So it's got a 72% premium to the sector on growth. And then if you look at the forward EPS for long-term growth, which is 3 to 5 years out, using a 3 to 5 year CAGR, its growth rate is actually a whopping 30%, which gives it an A plus grade over the sector, which is 9.9%. So even though the revenue growth is slightly lower for our forward estimate, the EPS bottom line remains strong, and the long-term EPS growth rate is significantly stronger. If we're to look at the company on a profitability basis versus the sector, we could see it has an A for net income margin. It has an A for return on equity at 24% versus the sector at 10%. And if you were looking at cash per share, it's an A grade. It's a whopping $37.89 cash per share versus the sector at $6.48. So just incredibly profitable. So Day, I'm going to take us back to our presentation. And we'll enlarge that slide. So for people who are on their phone, it's a little bit easier to see. The number 2 company is Clorox. This is a consumer staples company. It's great when I get to recommend a consumer staple company because normally the valuations are just too expensive, and many of these consumer staple companies have a hold rating. So it's great to be able to present a strong buy in the consumer staple sector. Clorox, ticker symbol CLX. That is a household product that is probably in most laundry rooms throughout the United States, and they have many other products as well. It's got a large market cap at 18 billion. In the consumer staples sector, it ranks 2 out of 188 companies, and within household products, it ranks number 1 out of 13. Now, this company is not down that much. It's only down 5%. But Dale, whenever you can catch a break with a consumer staple stock, especially in a market that's volatile or there's a lot of upcoming uncertainty, you take it. 5% is a good break. It's on sale. Basically, you look at it like you're going to the store and you're getting a 5% off on it today. The negative catalysts for the company are ongoing operational disruptions due to enterprise resource planning systems and depressed growth rates in certain categories due to cautious consumer spending. The positive catalysts are raised profit forecast for the fiscal year 2025, continued gross margin expansion for 9 consecutive quarters, which is really positive. And actually, if I go to Clorox, in the last 5 days, it's come off. But I'm going to go to our symbol page here, our stock page.
Yeah, had a little bit of a dip recently, but I mean, this company has major brands internationally. This is
But
just
I'll tell you what, if you look at this stock on a 5-year basis, it's actually down 6.76%. I guess that's not really that much, but you really don't get many opportunities to buy consumer staple companies at a discount. So as I said, you take advantage of it when it happens. So we'll go back to the slideshow.
Not to mention the dividends you usually get with a nice little company like that.
Yes, absolutely. All right, so we have a retailer here. So usually when there's uncertainty with the markets, people aren't fast to go into the consumer discretionary stocks. But Gap has had some great results. Another quant strong buy, ticker symbol GAP. Everybody knows the Gap. It's probably in every mall in America. Within the consumer discretionary sector, it ranks 21 out of 485. And within the parallel retail sector, it ranks 4 out of 36. The stock is down 8% in the last 30 days. Negative catalyst, inflationary pressures leading to weaker consumer spending and potential profit taking. However, on the positive side, there has been a reinvigoration with this brand that's been very evident through their earnings and the stock price. Gap reported for the fourth consecutive quarter net sales growth in Q3, and gross margins improved by 140 basis points year over year. And when you look at the report card of this company, you can see on the far right, it's looking really strong. The valuation is at A minus versus the sector. We rarely find that with stocks that have a growth grade within the A territory. Normally, those stocks will have a valuation grade in C or the D plus or even the D range. So it's really great to see growth. So we'll go to the platform really quickly. Typing Gap. So you know exactly what I'm talking about. So you can see the stock year to date is down 5.21%. But if we look at growth for this,
The EBITDA growth. Oof.
yeah. So the revenue growth is a little bit slow on it, but it just has some stellar EPS numbers as they reinvigorate their brand. So it's really coming through on the operational side, as you can see in the bottom line. In terms of the valuation, it is really cheap versus the sector. So the PE for consumer discretionary at 10.6 times, it's a 31% discount to the sector median, which is 15 times. And if we look at the forward Gap PE, it's 11 times versus the sector at 18 times. I really, and almost all the grades that you look at, and we look at this valuation grade, it's an A. To get that A, we look at a number of underlying metrics. So we're taking the score, and not all these metrics are equal weighted in terms of our algo. Some valuation metrics are more predictive than others. So we do have a dynamic weighting. It's not equal weighted, but you can see pretty much across the board, it's just fantastic valuation grades. And if we look at profitability, you can see gross profit margins are way better than the sector. You can see return on common equity is huge versus the sector at 29% versus the sector at 10.86%. So it's got some really great profitability numbers, and the cash per share, $5.22 versus the sector at $2.38, more than double the sector. So Gap looking great. All right, our next company, number 4, the airline SkyWest, ticker symbol SKYW. Company has about a $4 billion market cap within the industrial sector. It's 18 out of 615. And within passenger airlines, it's 5 out of 26. The stock has been a great performer over the last year, but over the last 30 days, it's down about 12%. The sector, I would say, is rubbing off on this a little bit. You've had some aviation accidents leading to sector or industry-wide pullback. American Airlines is down 15%. Delta is down 6%. So it's kind of had a ripple effect, even though SkyWest hasn't been impacted directly. The stock is traded in sympathy with it, down 12%. They have growing maintenance expenses, which were noted on the Q4 earnings call, and that had a slight negative impact. However, on the positive catalyst, the industry has shown long-term resilience, especially to past accidents. And specifically for SkyWest, the projected fleet expansion and a 12% increase in aircraft utilization for 2025 is very positive. So valuation for this, a C grade, growth is an A plus versus the sector, profitability a B versus the sector, and the revisions, that is proprietary really to Seeking Alpha. The revision grade is actually the number of analysts that are revising their estimate up versus the sector coming in at A plus. Stock number 5, Mission Produce. If you like avocados, this is your stock. Ticker symbol AVO. This is a small cap company with a market cap of 849 million. You can see over the course of the year, it's actually had some mixed ratings. We had some sells on it at one point, but that changed to buys and strong buys post October. And the stock has been volatile, and that volatility largely has to do with the threat of tariffs and then tariffs. But it's kind of sort of stabilized with that threat out there. Within the consumer staples sector, it ranks 8 out of 188. And within packaged foods and meats, it ranks 4 out of 54. The stock is only off 2% in the last 30 days. However, it's 20% off its 52-week high. And that's where I believe we should be taking advantage of it. The valuation framework is right in line with the sector, and growth with a B plus grade is stronger than the sector. So I believe it looks attractive. As I mentioned, the negative catalyst being on the tariff side, the positive catalyst being the tariffs were suspended until March 6th. Avocado AVO has a diverse sourcing strategy. It's also blueberries and mangoes as well, not just avocados. And they import from several other countries, not just Mexico. So I believe the negative news has really been factored into this stock, and it could be a good time to take advantage of it. And Victoria's Secret, our last stock, ticker symbol VSCO. Market cap is 2.36 billion. It's a strong buy. It's within the consumer discretionary sector, ranking 18 out of 105. Within the parallel retail sector, 6 out of 36. This comes in consumer discretionary, but undergarments are almost like a consumer staple. People will need undergarments no matter what. And Victoria's Secret might be on the pricier side, but it's been working. The stock had a great run. However, in the last 30 days, it is down 22%. There's been a couple catalysts out there. There's a new trend CFO, which that transition is announced in late January. That had an impact on the stock. There are some inflationary pressures leading to weaker consumer spending, and there are challenges in the Chinese market, which is the company's second largest market. So there have been a number of events out there. However, analysts still are taking their estimates up. So despite these events that have happened, the analysts that cover the company still have a lot of faith in it, and they've been revising their guidance up. And that EPS revision grade is an A plus. Again, that's sector relative. So we're looking at it compared to the rest of the consumer discretionary sector. So at A plus, it means it's much more positive in terms of the analyst revisions versus other stocks in the sector. So that is our full list of 6 beaten down stocks rated strong buy. We have Synchrony Financial, the Clorox Company, the Gap, SkyWest, Mission Produce, and Victoria's Secret. All strong buys, all with super growth rates, almost an A plus report card for all of them, with the exception of Mission Produce, which is, it's a consumer staple, so you're not necessarily going to get that A growth, but B plus is very strong, with very good profitability grades, straight A's across the board for the EPS revisions, which is really important because that shows that the analysts who cover these companies, the professional analysts, continue to have faith in the companies, and they're taking their estimates up. And again, that EPS revision grade is sector relative. So it shows you each company relative to the sector, analysts believe that it's doing better than the sector. So Daniel, that's 6 stocks. You know what I want to do? I want to take us to our platform, and I'm actually going to take us to the top 20, the top 10 stocks that we came out with in January. So there are more than just 6 beaten down the stocks. If you looked at the market today, you will see many of the indexes are down. The Dow is down 1%. The S&P 500 is down about 0.43, and the Nasdaq is down almost 0.5%. But what tends to happen in environments where there's uncertainty is companies that have performed well, that have strong fundamentals, believe it or not, they often sell off the quickest. What happens is people decide to take profits in stocks where they've made money, and they run for the hills. So they start reality capital from where they've had profits. They'll go into utilities, they'll go into consumer staples, they may go into the Mag 7 because those are the 7 largest stocks. They'll go into gold, they'll go into cash. So whenever uncertainty pops its head up, as we're seeing in this environment, people tend to sell really good stocks with strong fundamentals. So it's why I highlight you want to take advantage. Now, it may be more beyond just today. We could have several days or several weeks or several months where people are nervous and the uncertainty may continue. But you just look at these stocks and you can look at the factor grades, and you will see the fundamentals, despite the uncertainty of the overall environments, continues to remain strong. And what I'll point out here, this is an earnings page that I have for the top 10 stocks. And we look at the last quarter announcements, and we've been in our earnings period. You can see almost all these companies have beat on both the top line and bottom line side, meaning that the earnings or the revenues that have come in actually beat analyst estimates. And you can see PayPal, which has got completely walloped. So I'll go to the performance here. You can see in the last month, PayPal is down 14.65%. But yet when they reported, they came in with an actual of $1.19. It was 7 cents better than expected. And revenue reported at 8.37 billion actually came in 90 million better than expected. But it was like Walmart. They beat top and bottom line, but the CEO, hey, guidance could be a little bit softer than we expect for 2025. Stock got hammered, just like Walmart did today. Look at Brinker. Okay. Brinker is down today 4.85%. They reported their numbers. They came in at $2.80, 94 cents better than expected. That is a huge, huge beat. Okay. Revenue came in 100 million more than expected at 1.3 billion, and the stock is down 4.85% today. Take a look at Celestica. That's down almost 5%. That's been down the last couple of days as well. They beat both top and bottom line. So just like sort of highlights, we're in a period where there's a lot of uncertainty. We highlighted 6 stocks that we think will do well. Take advantage of it. Look at it sort of as just going to a store and getting these stocks at a discount. But you're likely to see this on many stocks that have good fundamentals right now. People are getting defensive. And what they do when they get defensive is they sell stocks where they've made money, irregardless of the strong fundamentals. People tend to panic. They go into cash, they go to utilities, they go to gold, and it presents a huge buying opportunity for the stocks that have really strong fundamentals. It's a lot of work to, uncover these stocks, Daniel. I will say, when I did it back in August, it took me like, I do this every day, and it probably took me a full week to pick the 6 stocks that I wanted. Probably about the same today. Took me probably a week to identify the stocks. Not everybody has that kind of time. So a lot of people really are gravitating to a product that I created about 2.5 years ago called Alpha Picks. So Alpha Picks is an advisory service where we actually select the stocks for individuals. It's separate than Seeking Alpha. Alpha Picks has a different platform. But what we do to make it a little bit easier for investors is we take our 2 top quant stocks every month. The trading day closest to the 1st of the month and the 15th of the month, I will send out an email with an article on the stock. And I also post it on a separate platform, which is the Alpha Picks platform. And we really have designed this for long-term investors. In fact, if a stock drops from a strong buy or buy to hold, we actually keep it in the portfolio for about 180 days. So this doesn't have a lot of turnover. If you're somebody who just wants a couple of good ideas a month and you don't want to do a lot of trading, Alpha Picks could be a product for you. And it's had great performance. As you can see at the bottom here, since its inception in July of 2022, Alpha Picks is up 175% versus the S&P up 62%. If you look on the top right-hand side year to date, it's up 6.3% versus the S&P up 4.5. 3 months has been a little weak. And I think what's interesting about that is, we're looking at a period where some stocks with excellent fundamentals have come off recently. So a number of our recent picks, and we pick these stocks because they're mispriced. So when you see a stock with a strong buy, it's a strong buy because we believe there's opportunity for the upside and that security is mispriced. So when you have a recent track record, and we have recently of the stocks coming off a little bit that we've recommended, that's actually a perfect buy opportunity. It's identifying the stocks as mispriced. Confusion continues with stocks that will go down. But after a couple quarters of solid earnings, typically these stocks rebound to the upside and big time. And we have a long history of doing this at Alpha Picks. Ever since the inception, when we started recommending stocks, we would run into periods when we first recommended them. They usually come off for a month or 2 months, maybe 3 months. Some of our biggest companies that are 10 baggers, 8 baggers, 7 baggers were initially off 5, 10, 15, 20, 30% in the first couple months. So it's really common for that to occur. But you could see we have a really good track record over 1 year, year to date, and since inception. So I would say take advantage of any near-term weakness that we've had. Sign up for Alpha Picks, and we handpick the stocks for you on a silver platter. We take our 2 favorite quant stocks once a month and deliver it to you. And as you can see, it has had great results.
Nice.
Daniel, I'll hand it over to you.
Yeah, great job on Alpha Picks, by the way. I mean, I love watching the journey of that portfolio continue to grow and watch you not only just close positions, but I saw recently there was a trim of a winner that broke over 100%. So I love to see how you guys manage it, and the communication's always there. So thank you for that. So what am I here to talk about? I'm here to talk about the dividend forum, investing forum coming up here on March 5th. We've been talking about it in the last few webinars, but now is the week I finally get to announce that we have registration open for this event. It's one that you're not going to want to miss if you're focused on dividends and fixed income. We have a great suite of speakers lined up, ready to go for that day. So March 5th, it is a virtual event. It will be here on Seeking Alpha. I'm gonna go ahead and ask the team here in the back if they can drop that registration link in the chat for all of you. You can go ahead and sign up. And if you're watching the replay, it'll be right below this video as well. We hope to see you there if you're interested in, preferred shares and baby bonds and really anything that pays a dividend, because who doesn't like a dividend? I don't know about you. Especially, I mean, we talked about consumer staples today. I have a few of those for my daughter. It's great. She gets dividends, it's reinvested, and we continue on with life. So I hope to see you there. And Steve, thank you again for these 6 picks today. What I would like to do is jump into a little Q&A if you got a little bit of
Sure.
time. So I'm going to scroll back up here. There's been a lot of people chiming in here today wanting to know things about the quant system that we had talked about in the beginning, or choosing these stocks, or the tariffs that might be happening. So let's start with this one. Why does quant compare company metrics against the sector instead of the industry?
A lot of times within the industry, there's actually not enough companies. So when we look at a company, we have to have enough data. There's not enough data. You really can't compare it to like an industry median. So for our quant model, and as you saw, it has a long history dating back to 2010. It's had a lot of success comparing to the sector. I mean, sometimes within the industry, you could have tighter comparisons, but with quant, it's a data-driven process. So we need a lot of data, and you get that when you look at companies from a sector comparison. Not enough data usually just within the industry itself. So as you see, when you go through these various industries, um, there's a tremendous difference. Sometimes they'll have 20 companies, sometimes they'll have 150 companies. So it varies across the board. We know consistently we get a lot of data when comparing to sector.
All right. So here's another question in regards to the quant system. So sometimes this person says, sometimes I'm experiencing that the company valuation in the quant rating moves a little daily almost. Huge swings from, an A minus to maybe a D one day and then back to an A plus. They're kind of wondering, why might those changes be happening on the individual factor grades day by day?
Well, that's a great question. Then usually with evaluation metrics, you're looking at price in those metrics, or you're looking at enterprise value in those metrics as well. So like you look at PE, price to earnings, that's the price of the stock divided by the earnings. EV to EBITDA is the enterprise value divided by the EBITDA. So the P and the EV move thousands of times a day. So it's going to impact those metrics as the prices move. It will not be stagnant. So really, you have to think as those valuation metrics almost the same as looking at a stock price. A stock price can move several percent, as we're seeing today. And when you're comparing those metrics to the stocks within the sector are moving. So it's not only for the stock itself where the price is moving, it's moving for all the other stocks in the sector as well. So there's a lot of moving parts. It's almost like a real-time model. So you might think that that is too many moving parts, but consider this. Do you want to invest in a system where it's refreshed every single day, where you're looking at the balance sheet, income statement, cash flow statement, how the price of the stock impacts the metrics? It gets refreshed every day. Or do you want to go to a research report that's 2 months old or 3 months old and make that investment decision? I know personally the reason why I created the quant system is I could not rely on looking at a research report that was 2 months old. That's like reading an article from 2 months ago and making an investment decision. An investment decision has to be made on the current data, and not only the current data, but really the data for a company versus its overall sector on a relative basis. So that's why you'll often see movement in the valuation grade, because the valuation grade is comprised of metrics that actually have metrics that move on a daily basis.
All right. Thank you, Steve. I'm going to go ahead and answer this one. This question comes in quite often. Is Alpha Pix a part of Premium on Seeking Alpha? It is not. It is hosted on our platform, but Alpha Pix is a separate subscription, just so that you're aware. And it is different. It is that 2 stock pick a month, as well as webinars with Steve and the team over there that are very detailed.
Dave, I think what I'll do is I'll actually go in, I'll give people a sort of a quick peek of what it looks like.
All right. A little bonus
So
content here.
again, this is the AlphaPix platform that I'm going to. It's a separate platform. You can see on the analysis page, we have every single article that's been written on every stock. So we're very transparent on this. And we not only show the articles, but we will show the performance as well. So we're going to take a look at the performance of the most recent companies. So going to give you a little peek. And as I mentioned, a couple of them have performed poorly, but the fundamentals remain really strong. So what's really cool about this is you're sort of getting a picture of what it looks like now. If I take a look at a picture of the returns, you will see some of the stocks from our past returns have monster triple-digit returns. And many of these stocks, I remember Super Microcomputer, we recommended it, and within like 2 weeks, the stock was down 20%. And I got to say, I think that happened with AppLovin as well, which is up 960% since we recommended it in November of 2023. It's just amazing the performance we've had on that. That stock was soft in the beginning as well. I believe Celestica was soft in the beginning. So many of these stocks where you're seeing these incredible returns experience the same type of weakness that you're seeing with the ones that have most recently been picked. So really, your timing is perfect to come in, that you could get these stocks that we've recommended that have pull off a little bit. Eventually, they should do well. It takes a couple quarters. Sometimes it takes more than a year, but stock markets always shift from sentiment and fear back to fundamentals. And that's what Alpha Pix does. It picks stocks with good fundamentals. And as I said, it's designed for long-term investors. So it's not designed for somebody who wants to invest and buy a stock today and sell tomorrow. Okay. You have to be willing to invest at least like 1 to 2 years with some of these stocks. But as you saw, the returns on many of them are immense.
Not to mention, if you do know somebody that can catch every bottom perfectly, let us know, because we all
I
want to
want
know.
that model.
Yeah, exactly. All right, here's another question for you, Steve. Where do the forward projections come from that we reference within the deck?
Great. That comes from Wall Street analysts. So the historical estimates, we have a model that's both historical looking and forward looking. So we take historical numbers and we look at those numbers. That comes in from the SEC, which gets reported to Standard & Poor's, and we get our data from Standard & Poor's. The forward numbers get reported into Standard & Poor's, but what Standard & Poor's does is they collect it from Wall Street analysts. So we're actually taking the consensus growth numbers for revenue, for earnings per share, for EBITDA, for EBIT. So it comes from professional analysts. Those growth numbers are not generated from Seeking Alpha. It is the consensus of Wall Street analysts.
All right, Steve, the people want to know tariffs. There's a lot of questions in here about tariffs. Obviously, you got companies like Gap and the avocado and the food side of things. Are you worried about tariffs with these stocks? I mean, what is it's potential risk, but what's the other side of it? What's the reward, right?
I think the CEO of Ford said it best. It's pretty chaotic, and they don't know what to expect. So like, if you have the CEO of Ford and GM not knowing what to expect from the tariffs, I certainly can't tell you what to expect, but I can tell you uh, that it is creating immense uncertainty. Nobody really knows if we're going to have the tariffs. If there'll be significant tariffs, if there'll be light tariffs, if they'll get adjusted with each country. It's just a tremendous amount of uncertainty, and markets do not like uncertainty. So historically, when you do have tariffs, it is very inflationary. And we could look, to history on a number of occasions where it has sometimes a short positive impact for U.S. companies because it enables them to get more market share, but inevitably they take their prices higher as well, and that creates inflation. So it has been a problem in the past. Tariffs typically do not end up positive for the economy or for the markets. It tends to have a very short-term positive impact, but the longer impact is negative. So, we're not certain how many of these tariffs are going to stick. And if we do have the tariffs, there's also the potential situation where taxes might be lowered in the US. So that could offset it. Um, so there's a lot of uncertainties out there right now, but historically, tariffs have not been positive for the economy or the markets.
I would like to highlight Anthony here in the chat who says, I'm doing well with your top 10 in 2025. Thank you, with like a billion exclamation marks. So nice to
Thank
see
you,
you
Anthony.
here. Thank you for the feedback. Let's see. Alpha Picks. People were wondering if they sign up for Alpha Picks, maybe you can go to that page that kind of showcases how Alpha Picks works here
Sure.
on the platform. They're kind of curious, like, okay, if I sign up for Alpha Picks and I have, the capital I want to allocate, what is the strategy when they sign up of what the pick is of the portfolio?
Right. So actually, I'm going to take you to the portfolio page. So we'll give a couple picks away here as well. So I'm going to rank it. So you see the last these are actually more than the last couple picks. What we do is you can go to that ratings page and you click on it, and you will see in descending order the strong buys. So you could buy one stock, you could buy 5 stocks, you could buy all the strong buys, or you can buy all the stocks. Now, that might seem crazy when I say buy all the stocks, but when we actually sell a stock, if a stock drops to sell rating, or if it's a hold for more than 180 days, when we liquidate that, we actually invested in all the stocks across the board. So that would be the strong buys, and holds. And many of our followers do that as well. So I actually provide the size of the holding next to it. So we don't know what your risk tolerance is. We don't know how much capital you have. So you could literally read through a couple articles and cherry pick which stocks you like, or you could buy a handful of stocks, or you could buy all the strong buys or all of them. So there are a number of different ways that you can go about it. If you want to learn more about the process, when you go to the About page, tells you a little bit about how we achieved that outperformance. But more specifically, it'll just mention a couple of the ideas that I had for putting fresh capital to work. And it tells you what our criteria is for the buy criteria, the sell criteria. And when we have winners, we let them run.
That's right. Very well put together portfolio. Questions on revisions. So I've seen this a couple times. People were asking about analysts. There's uncertainty in the market. There was a question about, can people trust analyst revisions, and how does that factor into the quant system grade, since we do have it as a factor?
Okay, so we'll look at Clorox. You can see it has an A grade. In the last 90 days, 18 analysts have taken their estimates up and 0 analysts have taken it down. I actually tend to have a lot more faith in analysts' earnings estimates than I do in their directional recommendation of buy, sell, or hold. I think Wall Street is pretty infamous for having investment banking that could potentially influence analyst ratings or block trades, or wanting to be the primary broker dealer firm that brings the company around on road shows. So there are a lot of things that could influence what the actual directional recommendation is. However, most of the analysts really want to get their earnings right. And they spend a lot of time trying to figure out what exactly the earnings will be. With a revision grade, we're looking at the quantity of analysts that actually move their estimate up or down. So it's not necessarily the percent change. It's not at all the percent change in the estimate. It's just the sheer quantity. And whenever we see 18 analysts moving their estimates up and none moving it down, it tells us that those analysts have a lot of faith in the company in the upcoming year.
All right, Steve, we get this question a lot on a lot of our webinars, actually, about alpha picks. They're curious, why are REITs not considered for the portfolio?
We use different metrics for REITs. So, REITs have FFO, AFFO, revenue per rental property. There's a lot of different metrics, and we do cover REITs. But since the metrics are so different than the metrics that we use for all the other sectors, we do not include it within Alpha Picks.
All right, Steve, I know we're coming up here at the top of the hour. There's the 6 picks from today: Synchrony Financial, the Clorox Company, the Gap, SkyWest, Mission Produce, and Victoria's Secret and Company. Can't thank you enough, as always, for taking your time to do this research for us. As we've been talking about here, I mean, and as you were talking, I like to dive into the simple pages, look at recent earnings announcements and things like that. But we appreciate you doing the research and giving it away here for free for us. So thank you as
My
always.
pleasure.
Thank you as always. And we hope to see everybody in the next webinar. Steve, I'm going to let you say a word if you want to, real fast.
Yeah, Daniel, again, thank you so much for organizing this today. And thank you to all the individuals and our subscribers that joined. And we could have some turbulent markets ahead. I just want people to stay calm carry on and look for good opportunities. It's great that we have the dividend webinar coming up, because really, when you go into certain markets that can last more than a couple weeks, I love a barbell approach where you have dividend stocks and then great stocks with great fundamentals as well. It's a really terrific balance. And we found 6 of them here today that have already come off a little bit. So take advantage of the weakness. Thank you for
All
your
right.
time, everybody.
You heard it from the Quant Titan, Stephen Cress. I'm Daniel Snyder. See you in the next webinar. Have a great week.